Hello, good morning everyone. Clifford Bennett, Chief Economist, ACY Securities, and I hope you're having a fabulous end of the week because you deserve it. Markets, look at that euro. Game over for the euro with the last hike by the ECB now out of the way. They're saying they will stay the same language as the Federal Reserve used, which is higher for longer. And I guess further rate hikes at the ECB are even less likely than further rate hikes at the Federal Reserve, and that's because the EU economy is in complete meltdown.
Hi traders, and thanks for watching. We'd like to take this opportunity to thank our incredible viewers for tuning into our channel. We would greatly appreciate it if you could hit that subscribe button, as we're pushing for the 10,000 subscriber mark by the end of the year. Now back to the video.
And the ECB is backing completely away from further rate hikes due, I believe, to political pressure from various nations that their economies are in recession or contracting. So what the heck is going on with interest rate hikes? So especially as inflation is unwinding but rekindling, and it will do so through the EU during this coming winter with again higher energy prices. Now, over in the US, a little bit of, the bulls always like to say, oh, look, retail sales are strong. But retail sales aren't keeping up with inflation. You have to understand that the retail sales data in the US is not adjusted for inflation. For instance, within the data yesterday, where retail sales did very well indeed, gasoline prices, actual prices of gasoline, were up 10% during that period. Yet purchases of gasoline were only up 5.2%. So the retail sales aspect of gasoline did not keep pace with the price increases, showing that demand is really very depressed in the United States. And this is true across virtually every aspect of the retail sales data. So just remember, it's not adjusted for inflation. And when you do adjust it for inflation, we're looking at flat retail sales at best at the moment for the United States. The other data we saw in the US yesterday was producer prices up a whopping 0.7%, which was virtually double market expectations of 0.4%. And again, another push on the Federal Reserve to not only maintain a strident jawboning of a tightening bias outlook, but to in fact push them at the second, third, or fourth meeting from now to actually raise rates again. So something the market hadn't been factored into, as I always like to mention, all those people who think there's going to be Fed rate cuts, completely wrong, have been wrong for the last 2 years, and are still wrong probably for the next 12 months as well. So the risk, the dominant risk, is the Fed hikes, the ECB doesn't, hence a lot of pressure on the euro. And as I said, I think it's kind of game over for the euro versus the US dollar because the EU economy is in such serious meltdown. It's not that the US economy is healthy, far from it. Retail sales are flat in real price indications. And, the manufacturing recession is ongoing. The hollowing out of cities is ongoing. All sorts of dysfunctional aspects of the US economy persist. But vis-a-vis the European situation, where you already have Germany in recession for 3 quarters now, 2 negatives, 1 0, hasn't returned to growth, probably isn't going to in the next quarter either. And you have Italy in contraction, and you have other smaller economies in the EU also beginning to contract. It's not a happy outlook whatsoever there. So expect the euro to become really under a lot of pressure now because there's not going to be any more rate hikes. They can't raise rates in such a stumbling economic situation. In China, mind you, they can cut rates as they did yesterday, 25 points. And that's because they don't have an inflation problem and people actually are concerned about the deflation risk there. The Chinese economy also, no soft landing still yet in sight. And so further downward pressure there on the overall global trade outlook too, because one of the reasons China is suffering is because exports are so weak, they're falling quickly. that's because global demand is weak. So China is weakening also due to external factors, and that's the demand from Europe, the United States, and around the world dropping away. And that's all of these processes are set to continue. In other words, the global economic slowing we've been forecasting for some time is entrenched, and it is going to persist for some time into the future, particularly in the manufacturing sector, but across all sectors. This climate of bearish sentiment will begin to take hold generally globally, I believe, as the world's 3 largest economies struggle to make headway. What more could you expect? Paradoxically, in that environment, the US dollar could remain firm. And also look at oil. Oil strong again, even though the US dollar was firm to strong. Oil gained again. So I've had to quickly eat my words about a 2 to 3 week consolidation phase for oil, and I've had to reestablish my longs. Another market you might want to look at is gold. I really feel we're close to the absolute gold low here, and we might have just seen it in the last 24 hours. So there's a risk reward opportunity there. Staying long unless those lows just seen were broken, and it could be a major uptrend. So we can't get everything right, but there is a risk reward scenario there that is a little bit attractive in the gold market at the moment. The Australian dollar held up while the euro crashed. I'm not sure how much longer that will last. I, again, am cautious. Equities, have to say, and I have a bearish view fundamentally overall for the US. That price action looks very bullish, but again, it's being driven by just a few big companies. So we'll see how it runs over the next 24 hours. Myself, I'm tended to fade the rally in the AUS 200, as I think the Australian equity market rally is sort of purely about, the US was up, so we will buy, without any true regard to the difficult scenario, both internally and externally, that the Australian economy and Australian companies face over coming months. I hope you have a good weekend. Thank you very much. Clifford Bennett.